Living on a salary of 15,000 rupees a month means operating without a margin for error. Between rent, utilities, and nutrition, the numbers barely add up. Building a long-term portfolio from this starting point requires navigating a narrow path between survival and investment. To find a way out, we have to enforce a strict baseline called the 50-30-20 rule. 50% covers your needs, 30% covers your wants, and the remaining 20%, exactly 3,000 rupees every single month, is the amount that must be carved out for investing. Investing that initial 3,000 rupees is only the first step. To change the scale of your wealth, you must follow the prerequisite step-up rule. As you grow your primary income through upskilling or side work, you increase your monthly investment contribution by 10% every single year. However, saving and stepping up your contributions is only half the battle. If you don't account for the steady decline in the value of the currency itself, your savings will lose their effectiveness before you ever get a chance to use them. When you fight hard to save a small amount of money, the instinct is to protect it. You look for safety, which usually means locking that cash into a fixed deposit at your local bank. This chart shows what happens to your cash over time. The red line is inflation, a 5 to 7% average, constantly eroding your uninvested money. Your bank numbers might go up with interest, but the actual volume of groceries that money can buy shrinks. By choosing capital safety over market exposure, investors often find themselves in a paradox. They protect their principal, but they guarantee a loss in what that principal can actually buy. For anyone starting on a lower salary, the primary threat to future independence is not market volatility. It is the predictable degradation of safe savings. Let's evaluate 3 strategies over 30 years. First, a 100% fixed deposit, yielding a 6% return. Investing $3,000 monthly with a 10% annual step-up, your balance reaches 1.11 crore rupees. But after inflation, the purchasing power is only 23 lakh rupees. This is the fixed deposit trade-off. You get a predictable return with no market fluctuations, but fail to outpace the rising cost of living. Prioritizing safety guarantees a specific outcome. You protect your principal, but you lose the purchasing power required to sustain your future. The second path is balanced equity, 70% large cap, 20% mid cap, 10% small cap. This historically offers a 14% return. With higher growth, it takes only 25 years to reach 1.7 crore rupees, a higher total than FD, achieved 5 years sooner. To achieve these numbers, you must accept market volatility. Your portfolio will experience periods where the value on your screen drops, requiring you to stay invested when others are selling. Success here depends on a multi-decade timeline. If you withdraw funds during a market dip, you stop the compounding process and lose the advantage of this strategy. By trading away the comfort of short-term stability, you shave years off your timeline and significantly increase your real wealth. The final column is the aggressive 10-20-70 rule. 10% in large cap, 20% mid cap, and 70% small cap index funds, targeting a 17% return. This hits the 1 crore milestone in 20 years, the fastest timeline of any option. The trade-off is significant. Allocating 70% to small cap companies means your portfolio will experience sharp, sudden fluctuations in value. This 20-year timeline only works if you have the discipline to hold your position through major market crashes. If a drop in value causes you to panic and sell, the math fails. You must also relentlessly follow the step-up rule. This growth engine only works if you are consistently increasing your primary income to provide the necessary capital. The 10-20-70 rule reaches the destination fastest, but it demands the most discipline and the most consistent effort to grow your primary income. Choosing your path depends on age and risk tolerance. On the left, with a short timeline or low risk tolerance, fixed deposits fit your needs, despite losing purchasing power. On the right, with a 20-year horizon, the 10-20-70 strategy effectively outruns inflation. Regardless of the path, compounding remains the same. It is reliable, but requires the uninterrupted passage of decades to reach its full effect. Your starting salary does not determine your final wealth. That is determined by how you navigate the trade-off between the comfort of safety today and the growth required for tomorrow.